Hello everyone, welcome back to the New Hampshire Business Show. My name is Chris Pastrana, and today we're here with Jack Wang from Longhorn Financial LLC. Welcome to the show.
Hey, thanks for having me on, Chris. I really appreciate it.
Absolutely. So let's get started. Tell me a little about yourself and what led you to, becoming a financial coach?
Yeah, so I have experience as a commercial banker. That's my professional experience. I got into finance years ago. So I tell the story to some people. So when I was a kid, young teenager, I remember my mother at the time had opened up a certificate of deposit for me at the local bank. It's $500 at 8% interest. Now you can think about sort of how long ago that was, right? To get 8% interest.
Oh, yeah.
And remember, so $500 at 8% is $40 for the year. And then she introduced me, one of her coworkers, I think, introduced me to this whole notion of a mutual fund. And I remember then she took the money, put it in there, and of course I was a kid, I didn't know any better, but this thing was going up $40 a day, right? So from then on, I was hooked, right? I was like, this is amazing, right? Why wait a whole year to make $40? I make $40 a day. Of course, you realize it can go down too, but as a kid, I didn't know that. But that was really how I got hooked. I started my career in banking. Actually spent some time as a corporate trainer as well. But today I actually have two boys, and then my wife and I live in Westford, so we're right on the New Hampshire border.
Yeah.
She has two kids, so we're living the running around to sports fields and activities, and my two are in college. Pretty typical family, right? So it's running around and, oh, honey, you got to go to this field, and I'm going to go drop off this one, and then I'll pick up that one, and you pick up that one. Whatever. Pretty much everybody deals with, most families.
Yeah.
Yeah.
That's too funny. Yeah, I know how you feel. Because my youngest two aren't, old enough to do anything yet, but the older two are, they're running around doing stuff, and it's like, oh, come on.
Yeah, I remember when I first met my wife and we started dating, her kids were younger, and I was neck deep in coaching baseball and stuff with my two boys. And I remember her saying specifically, gee, I can't believe you run around so much, right? You run field to field and, 3 days a week or whatever it was. I said, hey, don't worry, honey, you're going to be there too, right? And sure enough, right? That's what we do now. That's all we do. Run around for our kids' activities.
Yeah, it's sad. So tell me about being a financial coach.
Yeah, so after banking, left the industry and spent some time at one of the major investment firms. Got my licenses. What I really found at that time was typically the financial industry really helps people who have money, right? For the most part, right?
Yeah.
So if you have, $500,000 to invest, we'll talk to you. Otherwise, we can't be bothered. Things like that. But that's not me. That's, unfortunately, I don't have a $500,000 portfolio. So, what I want to do was really help people. And that was the main thing, right? So whether it was coaching baseball or volunteering or doing this, it's about helping people. But as you start to look around at the country and look at the research that's done, the average American family has debt. Don't have a lot in savings, right? And so, but those people need help also. They make good money, right? Perhaps mom and dad work, have a good income, but they don't necessarily know what they're doing with it, and they don't have enough money to save to get the attention of the big firms. So I really got into sort of this area, sort of this segment, because I really want to help people because it's such a huge market. I myself was there too when I was working in the corporate world. I was making really good money, but I had bills and activity fees and debt and everything else, and I remember the challenges that I had, of trying to build up savings, and then and then something happens. Oh, there goes the savings, right? Oh, and then something else happens. Oh, there goes, it's got to go on the credit card.
Yeah.
It's pretty typical, right?
Yeah.
So I want to break that cycle, help people break that cycle, and be smart about money, and start improving their situations. And what I tell people, Chris, is at the end of the day, whether you have $5 to your name or $5 million to name, it's never about money. It is just never about money. It's about the emotions and the values and, and your feelings and how you're raised with money and things like that. So oftentimes there'll be people who do things not for financial reasons, but for emotional reasons. And recognizing that is a big part of what I have to deal with in my practice is sort of, okay, you want to do this thing, that's fine. Just, hey, like, I'm not necessarily going to tell you not to. I don't think it's the best idea, but understand the consequences and at least go in with your eyes open, right? If you still choose to do it, you still choose to do it. Fine. It's kind of like smoking. People know smoking's bad for you, but they do it anyway, right?
Yeah.
So that's really kind of where I got into it, got the start, was really just kind of helping the average American family deal with finances, because I was and am the average American family.
Yeah, it's really cool. And I totally agree with you. I think it's an area that, kind of like we were talking pre-show, that people gloss over quite a bit.
Right.
Either they're scared or the media's got them kind of scared to take the reins on it. But money is slippery for a lot of families.
It really is. It's slippery. It's very, very emotional. And so, case in point, my own situation, not long after I graduated college, my dad used to work for the small computer company. He got some stock. Well, he passed away rather suddenly, and as an only child, he left his stock to me.
Yeah.
And I held on to it. It wasn't a huge amount of money, but I held on to it for an emotional reason. It was my tie to my dad. It was his stock. Well, I rode that thing to zero, right? Just right to zero. But I couldn't sell it for emotional reasons, even though financially I should have sold it, put it to work, been much smarter with it. Yeah. And so it's things like that that I've also experienced, that I now see other families doing or experiencing, that I want to be able to help with. I get it. It was like $10,000 that I basically just, but it was my emotional tie to him. So looking back, I understand it.
Yeah.
But it was $10,000 I could have done something else with.
Yeah. Yeah. Could have been much better off than with zero.
Exactly.
Yeah. Okay, cool. So I know one of your specialties is retirement.
Yep.
So let's jump into retirement a little bit.
Yeah, something that people don't really want to think about until it's time, right? Like anything, right? I'll deal with it when I get there. And what you find typically, on the internet or with these firms and most professionals is they do what's called retirement planning, which makes sense. Hey, Chris, you want to retire at age 65, so from now until then, you just have to save this much money and we'll invest it at this much. And by the time you hit 65, you'll be all set, right? And that's pretty much it. And it's a very much investment-focused approach. So typically it starts with that goal, when you want to retire. And then it's the risk tolerance questionnaire. And then from that spits out well, Chris, you should be this percentage in stocks, this percentage in bonds, this percent in cash, and there you go. Right. What I do is actually something called retirement income planning, which really looks at all the different pieces of what you have and how they work together and how to minimize costs. So for example, how do we maximize Social Security? Right? What are the strategies? And for married couples, there's literally hundreds of different combinations that they can do. How do we then time that with when you withdraw from the 401k? How do we use the equity in your home? How do we use other resources? How do we do it all in a way that minimizes one of the major costs in retirement, which is taxes?
Yeah.
So if you can minimize that, your money can last longer, right? So really, at the end of the day, the process I undertake, sort of what you have for investments, kind of doesn't matter. So the investment approach is, let me make you the most money I can make you. My approach is, I can't control how much money I make you because I can't control what the market does. What I can control is some of the costs. So if I can control the tax bill, then quite frankly, you don't need to make as much if you're minimizing the costs, right? So it's a totally different approach. And so it looks at a much more holistic view of someone's finances and how all these things work together versus, hey, what stock should we buy today, right, Chris? Like I said, in my view, it really doesn't matter that much.
Yeah. And because just some of the things you're talking about, but just by themselves could be incredibly confusing. Let alone try to make all of those pieces line up properly. I mean,
right. It's one of the things that I often tell people is one of the things that I find that keeps people from getting ahead financially is not picking bad investments or whatever it is. It's making unintentional mistakes. And that's all it is, right? It's unintentional mistakes. Mm-hmm. So what I'm talking about is because most people don't do this day in and day out, so they don't know the rules around Social Security, they don't know the rules around taxation. What I see all the time is someone does something, they did it, but they didn't realize the consequence. Oh, there's an extra 10 grand in taxes now you have to pay. Social Security, hey, if I claim now versus this time using this strategy, they don't see it, but I can show them, well, that meant that you just threw away $100,000 in lifetime benefits. Okay. And I'm not saying that you shouldn't have made those decisions, but again, going in with eyes wide open. So unintentional mistakes that we don't necessarily see easily sort of hold us back, right? And I see those all the time. And so I have a client who says, Jack, I really want to make this simple. I want to make my finances simple. So I was doing this for this client on the cusp of retirement. And the strategy I came up with is kind of complicated. And he said that. But I told him, I'm like, it has to be complicated because the tax code is complicated. The rules around Medicare are complicated. The rules around Social Security is complicated. So I have to introduce a certain level of complication to address those levels of complication. Because if I just had my 401k and that's it, yes, that's very easy. But then you also have no flexibility to avoid some of the traps, and you'll end up making those unintentional mistakes because you have nothing else.
Yeah.
So it's a different mindset for most people. It's a different approach than what most people do, because most people think, oh, I don't have enough money to invest. I won't talk to you. I was like, well, actually, you think about Social Security as the bedrock of your financial plan, your retirement plan. Why don't you just be smart about that, right? And then go from there.
Yeah. Yeah. So that's actually a really good question because Social Security is one of the things that's constantly being brought up, and I know you even brought it up in some of the post questions or pre questions. So let's talk about Social Security a little bit because that's doom and gloom in the media and all that. So that's probably a pretty good area to cover.
Yeah, you get a lot of news these days about Social Security running out of money. The truth of the matter, it's not that it's running out of money; it's running out of the surplus. When Social Security was first created after the Great Depression, for every worker that was collecting at that time, and there were very few workers collecting at that time, but for everyone who was collecting, there was, I think, something like 30 people, 20 or 30 people paying into the system. Mm-hmm. Okay, so everybody's chipping in a little bit to pay the benefits for this one person. Today, at the low point, it'll be 2.2 workers for every retiree. So people just aren't paying in. There just aren't enough people paying in to pay the benefits that have been promised. So it's not that it's running out. It's not that it's be bankrupt. But what will happen under the current course is that you'll only get about 77 to 79% of what you were promised. So, Chris, if you were supposed to get $1,000 a month, as an example, you would only get $770 or $790. Mm-hmm. So you'll still get something. It just won't be as much as what you thought it might be.
Yeah.
Right.
Yeah. But eventually, wouldn't that just lead to as that keeps going, that would kind of present a problem?
Well, I mean, it's a problem anyway because, people, the unfortunate matter is people are relying upon Social Security for their income, and yet it was never meant to be the sole source. At the 77 or 79% rate for quite a while, it will just stay there because Social Security takes in enough to be able to pay that out, right? So as soon as they take the money in, they're paying it right back out. So people still get their money. Eventually, I think with the millennial generation sort of getting to higher incomes and stuff, I think the system will get better over time because sort of my generation, Generation X, there's relatively few of us. So eventually you'll get to the point where there'll be a surplus again because you have a big population of millennials. But then when they hit retirement age, unless they have a lot of kids, they're going to end up having the same problem that the baby boomers that we're talking about now, right? So it'll sort of come and go in waves, I guess.
Interesting.
Have a lot of kids.
Yeah. Well, and that's the thing, is that population growth, the young are supposed to pay for the old,
right?
Essentially. But if that doesn't happen, because, population growth has been slowing down,
right, then
you can see those problems.
Right.
Interesting.
Right.
It's pretty cool. Yeah, so let's see. So you got Social Security, which is one that's constantly being brought up. Taxes, the other one you talked about, that is kind of interesting.
Yeah. Yeah, and people don't like to think about taxes. They think about it, once a year. Hey, I hand all my paperwork to my tax accountant. They fill out the 1040, sign here, get the refund, done, right? But really, taxes really kind of go through the year. And in retirement, there's so many things to watch out for because there's so many rules around taking money out of retirement accounts. But not only that, but it can also trigger hidden taxation. So if you go beyond a certain income level, there are taxes on your Social Security benefits. If you go beyond a certain level, you trigger higher Medicare premiums. So it becomes a game of sorts of how do you get money out in a way that you have enough money to live on, right? But that you don't unintentionally trip some of these thresholds. So, for example, if you go over the first Social Security taxation threshold, even if you go over by $1, it can trigger several $1,000s in taxes. So you cross the line just a little bit, and boom, there's an extra $2,000 tax bill. Well, you don't want to do that, right? So managing. That's why retirement income planning is about this kind of stuff. Is managing those things so you don't accidentally trip some of these unintended sort of landmines, if you will.
Yeah,
right.
That's interesting. Because I've heard that a few times before, and I think anyone that listens knows my viewpoint on taxes. But I think most people have them. Yeah. But it's interesting when you think about it, because that'd be pretty easy to be like, oh, I made an extra, a couple $100s this year.
Right.
Like, oh no, I just fell into a new tax bracket.
Right. And one of the things, sometimes people will say, well, I'm going to take Social Security early because I need the money.
Yeah.
But I'm going to continue working. Okay. Well, if you take Social Security early, but then you continue working, the money you earn can offset your Social Security benefits. So there are situations I see where people have taken it early, as early as 62, but they continue working at their job. Well, their earnings from the job and the formula that Social Security uses, it completely wipes out their Social Security benefits. So they've claimed it, they've locked in the low benefit for life, but while they're still working, they're actually getting zero, until they stop working. So sort of what's the point of that, right? Yeah. You might as well just keep working, not have claimed, and just get more later, or have done something else, let's say.
Yeah. Right. Yeah. That almost seems like they just don't understand how it works.
Yeah, like I said, all this stuff works together, and the coordination of it and the timing of it, because it can lead to a lot of extra costs that are just unintended. So I spend a large amount of time with my clients, sort of figuring this stuff out, right? So how do we do it in a way that doesn't wipe out your Social Security benefits completely, or just lead to extra taxation or extra penalties or whatever the case may be.
Yeah. That's pretty cool. So I guess here's a good one. When should they start planning for retirement?
Yeah. So a lot of people, will kind of think about after my kids are out of college, and after I'm done paying that bill, then the next thing will be, say, retirement. I'll focus on it then. What I encourage people to do is start much earlier, whether it's saving in the workplace, retirement plan, or otherwise. But here's the thing. Retirement income planning and having that flexibility to avoid these landmines involves having different buckets of money. So it's not just the workplace 401k, but it might be tax-free money like Roths or permanent life insurance or other things. So, to have the flexibility later, you want to take steps now. And the earlier you take steps by creating these different buckets of money, the earlier you start, the more you're going to have, obviously, but then you will have the flexibility later because some of these options might not be available later.
Yeah.
Right. So people say, well, I can't really do that. I don't have the money. I get it, but let's maybe find the money. Let's be smarter about some other stuff, about debt. Maybe you're contributing more than the company match, so maybe you back that off. So you only contribute enough to get the company match, but then anything above and beyond that you were doing, maybe we redirect it over here, right? So there's different ways to start this process. So obviously, the earlier you start, the better off. But again, what I tell people is the way you save and what you save into is as important as sort of like what you pick for your investments, right? We talked about the taxation thing and everything else.
Yeah. That's pretty good. So let's see. So I guess the next thing we can jump into is we kind of brushed on it earlier, where more people are in retirement,
right? And
people are living longer. So by the time they're getting ready to retire, how long typically should they be planning? If that makes sense, like how much money should they be planning there? Because there's a lot more than there used to be.
Right. Yeah, longevity. Longevity is the biggest unknown, and it's and often referred to as the risk multiplier. And the reason it's a risk multiplier is if you think about the risk in retirement, so whether it's taxation, making your money last, even healthcare, long-term care type of expenses. If you retire today and pass away tomorrow, you don't have to worry about any of this stuff, right? None of the stuff matters. But unfortunately, unfortunately, most people aren't in that situation. So the longer you live, the more this stuff matters. And so the average male who's 65 today can live to early 80s. Average female into the late 80s, into early 90s. If they're a member of a couple, they're into, there's a good percentage that at least one of them will make into the 90s. There's sort of this running joke. The key to longevity for men, there was a study done by some organization, so it's kind of funny, but the key to longevity for men is being married. The key to longevity for women is being single.
That's kind of funny.
Yeah, it's pretty funny. I read that, and it's what the numbers say. But, you're looking at potentially, 90 plus. There's a growing percentage of the population that's 100 plus. So what that means, conceivably, is that you might spend as many years in retirement as you spent in the workforce. Think about that.
Yeah.
Right? So all the years that you're working, you have to save up enough to be able to support yourself for as many years, for the same number of years, but on the golf course or, whatever it is that you like to do in retirement, right? So it's a big issue. And so, studies have been done and sort of planning around this. How much should I take out of the 401k? You have to account for the fact that you're probably going to be around for a while. So you got to be kind of careful in terms of withdrawals, which makes this whole thing, again, another layer of complication. Because you take too much out in the beginning, then the money isn't there later for, when you're older, right? And we don't want that, so.
Yeah, and that's very interesting because I knew people were living longer, but I hadn't even thought about, we were just thinking about maintaining the way you live almost twice as long.
Right.
And when people typically live up to their means throughout their life, to even think that they should technically have twice that amount of money is is pretty, dazzling, I guess.
Yeah, and part of it is, people say, well, I can always cut back on my expenses and stuff, and that's true, right? That's true, Chris. We can always cut back on our expenses. But, I think back to, when I was in college, right? And I used to go away with my buddies. We thought of nothing of, piling 6 guys into a car and then, 6 people into like a small hotel room or whatever.
Yeah.
I'll sleep on the floor. I don't care. Well, that was then. I need a comfy bed today. Right? I don't really want to pile as many people in the room as possible. I want my comfy bed.
Yeah.
So, kind of our standards get raised. So in retirement, people can say, well, I can cut back on this. I can cut back on this. Yeah, but do you want to?
Yeah.
Yes, I can eat ramen noodles, like, the joke for college students. Do I want to today?
Yeah, like,
not really.
You're an adult. You worked your entire life. You're used to, even middle class life. Do you want to go back to just living like you're in college?
Right.
Yeah, it'd be crazy.
Right. So, it's something that people, unfortunately, what the research shows is, because the average American family really hasn't saved enough, and they don't necessarily understand all the rules around this stuff. Their retirement income tends to be kind of low, and so they end up cutting back because they have to.
Yeah.
Right? Not because they want to, whatever, but they have to. And that's not a position that I would ever want for myself, or I would ever want for any of my clients.
Yeah.
Right? For anybody, quite frankly. It's no fun.
Absolutely. So you have any other good advice before we head up?
Yeah, again, it's what I tell people is, if you don't know the rules, you can't win the game. And just reading one article on the internet or watching one YouTube video, unless I suppose you watch this video, it's hard to know all of these things. Get professional help, whether it's me or otherwise, but get professional help, because it is so complicated, and is just, again, easy to fall into those traps. So if you don't know the rules, you can't win the game, and you want to win at this game.
Yeah. You at least don't want to lose it.
You don't want to lose. That's absolutely right.
Okay, cool. So thank you so much for joining me today. It's been a lot of fun, and I think I love hitting on these topics because I think they're really important. So thank you.
Excellent. Thank you so much, Chris. I appreciate the chance to be on.
Absolutely. That's it for today, everyone. But it doesn't have to end there. Head over to iTunes, Stitcher, Google Play, or iHeartRadio to get more from New Hampshire's top entrepreneurs.